Hi, I'm Jesse Fulton, Marketing Manager with Index Fund Advisors, and I'm here today to discuss an important topic that is avoiding the RMD tax bomb. RMDs, or required minimum distributions, are tax hits that you know are coming in retirement. And for many taxpayers, there are powerful tools to help spread out such a tax burden, particularly for those who have a lot of their retirement savings held in tax-deferred accounts, as opposed to tax-free 401k accounts. I have with me today Kirk Ito, who is IFA's own financial planning analyst, to go over RMDs and help alleviate some of these tax burdens or find ways to do so. So welcome, Kirk. It's nice to see you.
Thanks, Jesse.
Can you go into defining what RMDs are and how they work?
Yeah, so RMDs are required minimum distributions, and what happens is during your working career, you've been saving into tax-deferred accounts. Fantastic idea. It controls your tax liability while you're working, right? So while you're earning more, potentially reducing the amount of taxes that you have to pay during that career. For a lot of our clients, they've built up quite a bit of their assets within these tax-deferred accounts, right? We have massive IRA balances, and that's fantastic. That's a great place to be. You've done a diligent job at saving during your working career, and now you're entering into retirement, right? So we go from accumulation to distribution, and when that happens, there is I guess a distribution strategy that we can use, right? So we can take pro rata, just take money from all the different types of accounts that we have, and I'm going to categorize these as taxable, tax-deferred, and tax-free, okay, right? And so a taxable account would be your individual brokerage account or investment account. It's taxed on an annual basis. Tax-deferred accounts are going to be 401ks, IRAs, those types of accounts, and we get tax-deferred growth. We weren't taxed on the front end, but we will be taxed on the back end when we do take distributions. And then tax-free are our Roth holdings. So Roth IRAs are going to be after-tax money going into fund, and then when we take the distributions, no tax on the back end. So kind of the reverse of the tax-deferred accounts.
Sure.
And so tax diversification, if we've done it correctly, gives us our options to choose which accounts we're pulling from. Now, the default distribution strategy should be taxable, tax-deferred, tax-free, to allow those tax-advantaged accounts to grow to the best of their ability, right? But that's not always the case. Assuming that's the case, when we enter into distribution, the IRS wants their taxes on those tax-deferred accounts, right? So they institute RMDs at age 73 currently. And when we start those RMDs, it's based upon your age. It gives you a factor of the total account balance that was left at the end of the previous tax year. So December 31st of 2023 gives us our RMD liability, assuming I'm 73, gives us our RMD requirement for this year, right? And now that distribution is coming out, and I'm paying taxes on that as income, right? The idea is that now I'm having this distribution. Well, what happens, and I'm using that distribution to fund lifestyle, right? But what happens if I don't need that distribution? I've got a pension stream or Social Security, and I've got a good handle on my expenses. I don't need this extra money, but they're forcing me to take it, right?
Yeah.
And so that's not a bad thing. That's right? We've got worse problems that you can have. But when that does happen, and we're just taking RMDs out, what happens that people might not be foreseeing without projecting out and making some of the assumptions that we do in financial planning software. They might not see the accumulation still occurring in those tax-deferred accounts, right? Mm-hmm. So if you have a relatively large balance in your IRA, there are a couple of things that we can do ahead of time to mitigate that growth in that tax-deferred account and very, very large RMDs later in life.
Okay. So can you get into a little bit more of where some of these problems might occur? with your savings being in traditional 401ks or pre-tax IRA dollars versus post?
Yeah, absolutely. So I mentioned tax diversification and making sure that we have assets in all of the different types of accounts. It gives us a little bit more control of which accounts we're drawing from at certain years. So for example, if I have a client that has retired, they're choosing to defer their Social Security income, they may have this lull in their tax bracket where it gives us an opportunity to take advantage of Roth conversions. So I'm going to take some of the tax deferred dollars, I'm going to distribute it out of those tax deferred accounts and then convert them to Roth IRA assets. And they're now going into the tax-free bucket. And so the timing of that is going to be based upon whatever tax bracket. If we can get you to one of the middle tax brackets, 22, 24%, using that IRA conversion to fill up that bracket, that might be an efficient use of that 1 year or multiple years in your scenario. So everybody's different, of course, and so what we want to do is take a look at the effects that has on your tax-adjusted ending portfolio value, right? So am I maximizing the growth of my portfolio based upon tax status?
Sure. So that was one way in which we can avoid that potential tax time bomb, the Roth conversion. Another one, there's a couple others, donating to a qualified charitable trust.
Yeah.
And then also the donor advised funds.
Yeah. So with a qualified charitable distribution, what you can do is those RMDs further down the line, if you're charitably inclined, you can satisfy your RMD requirement by transferring that RMD directly to a charity. And so it's called a qualified charitable distribution, or QCD. And when we do that, it's a non-taxable event. Well, it nets out, right? So
Sure.
We are able to maximize the amount of dollars that are going to the charity while still satisfying that RMD.
Okay, so while one is working and they're accumulating wealth, during that accumulation phase, how much money should one stash away into Roth accounts versus your traditional IRA accounts?
Yeah, and that's a great question. Obviously, everybody has stages in their career, right? I start out, maybe I'm not in a high tax bracket because I'm working at Burger King, or I don't even know if they have Burger Kings around anymore, but I'm working somewhere and I'm not earning that much. I'm in a very low tax bracket. Might be a good time, and this is anything below like 12% or below, right? But if I'm in a low tax bracket, then most of my savings, retirement savings, can probably be directed to Roth because taxes aren't a big concern of mine at that point.
Sure.
Now in the middle of my career, now I'm in a 22, 24% tax bracket. Maybe I split my contributions so that half of it's going to qualified and half is going to Roth, right? Now I have diversification there. If I'm in the upper tax brackets, then I'm probably going to want to reduce my current tax liability and use strictly qualified accounts until I get to that period where I have a dip in my tax bracket. So
now, for the common person, how are they going to know how and when to do this?
So I would talk to your financial advisor, wealth advisor, and then make sure that you're running it past your tax professional. So
yeah, because obviously this would be a lot to do for on one's own.
yeah, absolutely.
Knowing when to do it, how much to do, etc. So it's very important to talk to your wealth advisor.
Yes, yeah, and your tax professional. Talk to your
yes.
CPA. Make sure that you're filling up the right brackets. We don't want to do anything necessarily to bump you into the next bracket. It'd be a less efficient use potentially. So.
Well, I really appreciate you taking the time today, Kirk, to go over the RMD tax bomb and some of the strategies as far as avoiding that. And appreciate your time.
Happy to do it.
All
Thanks,
right.
Jesse.
Thank you, Kirk.